please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
There goes the gong, and it's 0.25% higher on the Nifty. It starts with 10,745 to 50. And the Sensex starts 70 higher at 35,320, about 0.2 higher. Now the Nifty is putting on a little weight and moving towards 10,750. The mid-cap index is also starting with decent strength after the 2 or 3 days of battering it has got, and especially yesterday. So up 0.4% at the moment. The Nifty Bank minor, okay, not underperformance. It's almost neck to neck with Sensex and Nifty. It's up 0.3%. Titan is the king of the Nifty today, starting with about 2% in terms of gains, 1.8 to 2. Vedanta has done well. Asian Paints is up 1.3 after the numbers. IOC is jumping a little bit of a relief from 78 to 77 on crude, 1% higher on IOC, HP, and I think BP as well. IOC and HP are exhibiting more recovery. HDFC, Tata Steel, L&T, UPL, Indiabulls Housing, many of them like Indiabulls, which found a lot of short selling yesterday, are recovering today. It's a very green screen, now putting on a little more weight, 10,760. I'll just bring up the green end. Obviously, telecom stocks, Bharti, Airtel down 3.5%, and the pharma stocks. Sun Pharma is down about 0.5%, but not a whole lot. Other than Bharti, there are not too many losers.
It's a good opening for the mid-caps as well, Lata, up almost about 60 points for the index. The market breadth is positive, almost 3:1 in favor of the advances. The stock on the upside is PC Jewelers. It's up almost about 12%. It's getting excited because of the 350 rupees buyback price. But remember, the acceptance ratio is quite low, so investors need to be aware of that. Ujjivan is up almost about 4.5%, reacting to their numbers. It's hit a new 52-week high today, so that one's doing well. You have Fortis Healthcare, that's also moving in the green. The last time I checked it, I think it was up almost about 1%. Now selling off a bit, so down about 0.7%. Apollo Tyres, Ingersoll Rand, a couple of these result reactions should also come up for you. Apollo Tyres up almost 1%. Emphasis doing well. Nestle is up almost 2.5%. And on the downside, you have Union Bank that's down post its numbers. Canara Bank ahead of its numbers under pressure. It was a short call from Ashwini as well. And the entire telecom pack is under quite a bit of pressure after LGO has come out with that post-paid plan, so there'll definitely be more operational stress for the other incumbents. Bharti is down 3.5%. Idea is down almost 6%, so bleeding over there. But otherwise, for the market, it's not bad actually. The Nifty has opened now well above the 10,750 mark.
Oh yes, and looks like good enough opening. In fact, for the Bank Nifty as well. But mid-caps, I think that's something that I'll watch out for, because the start has not been that good for mid-caps. Ashwini, your thoughts on market opening?
See, it's basically range bound, but what is interesting is that now we have the IT stocks which are moving up. So maybe even though the rupee is strong, that may be the place to look at, because the others are domestic stocks. So maybe the global strength gets played into by these IT stocks. That's some place that I'll be looking at. But overall, I don't think this market is really going to have a trending move. In fact, the banks will probably start to come off soon.
IT and metals as well, isn't it, in your global pack? You wouldn't look at the Vedantas, sales, JSPLs, any of them?
They had a bad day yesterday, so chances are IT and metal recover a bit today. But overall, the market remains kind of sideways.
Okay, I just wanted to point out a couple of results that came yesterday and are lesser noticed companies. Ingersoll Rand, like I told you, up about 20% now. Yes, 20% locked in. Very good numbers from Ingersoll Rand. But Kennametal was the other smallest stock that's up about 7%. And Elantas Beck, actually, I thought the numbers were not all that great. Revenue is down 3%, EBITDA down 20%, margins down 400 basis points. It was a one-time gain that kept the profit higher, but the market is still rewarding Elantas Beck. Mitesh, any stock on your radar now?
I think the Nifty isn't showing strength to get past this 10,760, 780 zone. So maybe early morning trade could be more on the short side. I have identified Godrej Industries, which is kind of breaking below the critical support levels of 580, 579. I think just trading below that. So if it sustains below that for another 15-20 minutes, that could be a good shot. Keep a stop just about days high. Look for declines to about 560 zone.
Okay, since you're talking about shorts, Idea Cellular, by the way, is getting pummeled now. A new 52-week low for that one, and huge volumes getting traded on the downside. Ashwini, would you trade any of these telecom stocks? Would you short them today, given the news flow?
I don't think there is much left out there. You want to do stocks which are making new highs. So even if you want to go short, maybe things like PSU banks or NBFCs, etc. I don't think telecom beyond a point is a great short.
Okay, the other stock which is really interesting is Stride Shasun. I think something's wrong here because yesterday also it was down about 8%, and today the first opening tick has been used to sell into that stock. And that stock has made a fresh low as we speak. So, in fact, both granules and Strides over the last 2 or 3 days have seen massive selling. And Strides in particular, the way that stock, I mean, 2 days back it reacted positively on that deal announcement, and after that it's been just one way down on that stock. So just keep an eye on this one. Ashwini, what would be your big call for the day then?
See, I think I would get long on IT already. I think Tata Elxsi and TCS are moving up. The market overall is coming off, so probably short on banks and long on IT.
Okay, just one more word before we wind up our pre-market and opening conversation. Sandeep, there was a lot of talk that because of the electrification of the last village and the effort to electrify every household, transformers will do well. Old-time transformer number were not anything to write home about. That stock is down 6% in opening. But is that space something you'll look for?
I think every time we try to figure out and say that electricity comes, okay, then you'll have the cable companies doing well, then KECs of the world, or the transmission companies, and then of course consumer electronics. I think that lead lag effect is going to take a huge amount of time for an investor to really capitalize upon. So transformers and all, I think is going to be quite some time away before they see this kind of orders which could move their P&L or impact their balance sheet in any positive way. So it's good to hear, but stay away from it. There aren't much investable options there right now.
Okay, Sandeep. Thanks a lot for your time today. Prakash, any stock looks good to you?
Yeah, I think Asian Paints looks good. Can see a climb to around 1260 zones. Bharti, Airtel looks weak. We could see a slide to around 380 zones.
All right, gentlemen. Thanks a lot for taking us through the market opening. Let's now invite our market master for the day, Sanjay Mukim, Director, India Equity Strategy of Bank of America Merrill Lynch, is with us. Sanjay, good morning. You reckon the market's done with the correction and is ready to move on now towards the new highs, or you think there could be some more setback for this market in this year?
So you're asking the wrong person, frankly. I stay cautious in the market. I think that the recovery that we've seen largely is on the back of the banks moving back up and consumer staples doing very well. But we are worried for a couple of reasons. One, the macro concerns on India are only getting worse. You've seen what's happened to oil prices and consequently the rupee. Into the election year, fiscal stresses for government can only accumulate, as again coming out of oil. And earnings in themselves may not be sufficient to drive the market. So we did some analysis recently where we did statistical correlations of earnings growth and stock return. And on a one-year horizon, there is zero correlation between earnings and stocks for data for over more than 10, 15 years. But there is a lot of correlation between stock earning beats and stock returns, 60 to 70% correlation at least. Okay. And our argument is that even if the growth recovers in India, you are not going to see earnings beats from estimates because expectations have become very, very high in the country. So both from a micro basis and macro, I do think that the market's going to be challenged for the rest of the year.
But good morning, Sanjay. There is still a positive macro environment globally. With the inflation numbers in the US coming in lower than expected, it looks like Goldilocks and how. So if that is the overall ecosystem, then do you think there's too much fall? Is the downside also not too much?
Right, I would refer you, Lata, to the other variables, which is interest rates. So everybody focuses, let's say, on the 10-year US rate, which has gone to almost 3%, but even the 2-year has gone to 2.5%. It's been rising very steadily. So one of the big drivers of global equities and asset prices over the last few years has been the opportunity cost of capital, lower interest rate, the amount of liquidity the central banks have been pumping in globally. And that is turning. While the net purchases by central banks is still positive, we expect that to turn neutral or negative over the course of the next 2 or 3 quarters. And of course, the rise in interest rates themselves can be a big deterrent to asset prices. So, and that's the big risk, I would argue. So even if the growth comes back, you may not see adequate response from equity prices.
Okay. Sanjay, hi, good morning. You did state a lot of risks for this market, macro, earnings, etc. What about politics? Does that feature in your list as well?
Well, to the extent that politics will have an effect on the economy, I think that outcome is still uncertain, because it's the general elections are at least a year away, and whether they or not will lead to any policy shift in central government is anybody's guess. But what will happen, I suspect, is that media for the next 12 months will be very noisy related to campaigning from both sides. You will hear a lot of news flow telling us of stuff that is wrong in the country, because that's part of one side's campaign. And it will not lead to a good tone for investors, especially those outside of India. And while we've had this big run-up in 2014 when everything looked hunky-dory, I suspect that what we're going to see is going to be a bit of a mirror image of that at the moment. So I'm not sure that politics will actually have an impact on the economy. I think it's too early to tell. But the overhang can certainly be a bit negative.
Oh yes, I am from media, and I think I'll agree with you on that one, Sanjay. But you know, in terms of markets move from here, then for investors, what should be the mantra? Last year spoiled a lot of people, right? 44% mid-cap index growth, mutual fund NAVs, growing 50-60%. What should be reasonable expectation, and where should the investors park their money then?
Right. So look, I say this very often, that a PE multiple in India, of course, they are very high, but the multiple is a very, very bad indicator of timing. You cannot sell the multiple because it can stay elevated for a long period of time, as has happened in India and globally for many years. But a high multiple is an expression of risk. The higher multiple that I pay, the higher risk I am taking in expectation of further return. And at these valuations, the mantra, as you suggested, would be to avoid risk. How do I avoid risk? I stay out of mid caps. I prefer the large caps. And I stay with companies where there is little operational risk, where businesses are fairly transparent, management quality is ascertained, and so on. It's a very boring sort of a large cap portfolio in India. But that's what I would recommend for relative investors in India. So you're right. So our portfolio is that retail-facing banks, staples, cement. We have a big theme arguing that rural India and housing-related stuff should do well as in the next few quarters as well. Some NBFCs, NBFCs are big pack nowadays, but some NBFCs are better placed because they have better credit ratings and should be able to absorb the hike in interest costs and possibly gain market share as a result. But yes, you know the names that are very common in investor communities, but that's where you would stick. And frankly, we've been saying this for a year, and that's been the portfolio that has been performing as well.
You also like some of these ancillary companies, right? Paints, appliances, furniture, etc. Would you not be concerned about higher crude prices impacting the operational performance here?
They will. In fact, there is very clear evidence over the last, let's say, 3 or 4 years that the decline in commodity prices led to significant margin upside for Indian companies. And a lot of earning strength, whatever was available for mid-caps, came out of margin expansions. And as that reverses, there is likely to be a miss on margins for a whole bunch. We've started to see, at least in some results, evidence of that, but I suspect that the lag impact is still going to come through. So for many consumer-facing companies, I think markets will have to reassess downwards their margin expectations over the next few quarters.
Okay, and IT?
So look, that's a bit of a tricky situation. We've seen a massive rotation of investor interest into IT, frankly. The stocks are not cheap, especially some of the large ones. But we've not seen too much of earnings upgrades yet. Yes, there has been some incremental positive commentary on demand, but despite that, earnings expectations have not changed too much, but stocks have gone up. So I think that whatever IT rotation we've seen is finite, and you're not going to see a continued theme through the year. Of course, concerns on the currency as started to accumulate now would mean that you would be favorable IT, that you would probably still keep some of your portfolio in there should the rupee were to depreciate. But fundamentally, we are not convinced yet that the demand environment has improved meaningfully.
All right, Sanjay. We will have to leave it at that. It's results season. We have a lot of corporates. Thank you very much, Sanjay, for joining us. And the best performer of the last 24 hours in terms of earnings and maybe even stock performance is the stock on our radar, Titan. Excellent operational performance. Margins have improved by about 150 basis points for the fourth quarter. And EBITDA growth significant for the year. I think it's about 45% growth for the full year. S. Subramaniam, CFO of Titan, joins us. Good morning, Mr. Subramaniam. Clearly, the market's pleased with the performance. It is the leading stock in the Nifty when I last checked. But if you could give us some more color. You could squabble a little with the revenue. It's missed the street a little bit in terms of expectations.
I think great year. I think I should start with that. It's been a phenomenal year. We've done well above our own internal plans. So in terms of revenue, I have absolutely no problems, even if it seemed to be a little lower than what was expected by the street. And that's also because of certain corrections that we had to do in the watch business. We did a consolidation of the redistribution stockists. And that would mean that at least the growth in the watch business was muted. As far as jewelry is concerned, I think it's been absolutely exceptional. And let's not forget, last year, the same quarter, the growth was something like 58%. So to grow 13-14% on that basis was really phenomenal. But I think what was so gratifying was the gross margins. We did exceptionally well on the margins in all our businesses, particularly in the jewelry business. The studded ratio was good. Even on plain gold jewelry, our margins were exceptionally high. So I think that's what has driven this, along with our, of course, the focus on cost over the last year and a half. I think they've driven they've been, I think, executed quite well, and very happy to see the margins that we finally ended up with.
Okay, Mr. Subramaniam, good morning. Yes, the street was actually very excited with the retail sales growth in the jewelry business and the gross margin expansion, but that was also because of the wedding season. You had some exchange scheme offers as well. Do you think that would continue to sort of grow the business, the jewelry business, by 20-25% over the next couple of quarters? And on gross margins, is there scope for more expansion?
On the growth for the next few quarters, I think we have to take it quarter on quarter, because let's again not forget the base for the first quarter is extremely high. We did extremely well last year in the first quarter. So to that extent, I can't say we will grow 25% every quarter, but that seems to be the goal, between 20 to 25% for the year. And that is something that we are gunning, and we hopefully should be able to achieve that. Again, the confidence level is reasonably good. Okay. So that is as far as sales are concerned. So I would not therefore give you a guidance on a quarter-on-quarter basis. That won't be fair. On the margin side, I think we also need to be a little cautious, because I won't go by one quarter margin. Whenever we have the diamond studded activation, we tend to have higher margins in that quarter. And the next quarter, for example, will not have that. And therefore, the margins will not necessarily be the same as in the previous quarter. And therefore, I think one needs to calibrate that. I would look at it from an annual basis. That makes more sense, rather than looking on a quarter-on-quarter basis. So overall, I think we should be able to maintain somewhere our gross margins. And even if we fall a little, I won't be worried, because I think EBIT margins can be better if we get operating leverage. So any growth over 20% should give us EBIT margins which are better. Yeah.
So what is the EBIT margin you would guide?
I wouldn't guide. I would say that we are more focused on getting our top line. I think this is a great time to look at market share gain. We've been looking at that for the last 2 years. It's been helping us. And we hope that once we get this, EBIT margins will grow. But that's not the real target. The target is to get the top line here.
Okay. Mr. Subramaniam, good morning. I think I asked you this last quarter as well. Is it time to now become pure jewelry company? Looking at watches and, eyewear and perhaps use those real estate as well, towards jewelry, because the other businesses aren't really contributing at all.
I think you asked this question, I also answered it last time, and I'm going to give it the same answer, which is that let's not forget the number of customers that we actually cater to today. We cater to more than 15 million customers in watches, about a couple of million in the eyewear business, and a couple of million in the jewelry business, so about 20 million. We have a loyalty program which runs across all of these. We do a lot of cross-selling between these customer bases that we have. And therefore, I think it makes a lot of sense to have all of them. Let's not forget, watches by itself is a very profitable business. What's wrong? Just because it contributes now lesser than, say, around 15 to 16% of our top line and profits, it doesn't make it any smaller. And it's the business we started with. We are doing very well. We are the market leaders by a far margin. So, and the eyewear business, we are definitely number one in the country. While the growth may not have been great in the last year, I think that's largely to do with the sunglass and the GST issue. And I think that we should hopefully correct this year. These are good businesses. Sir. We are market leaders in every business we are. And it does not distract management.
I agree. And I agree. And I tell you something, the first watch that I used was of Titan. And, obviously there's a bit of an emotion about it. I am referring to, there's a real estate involved here, right? When you have an eyewear store or
it doesn't matter, no. I disagree, because most of those stores are actually franchisee stores. They're not company stores at all. And secondly, I can't put up a Tanishq store in 700 square feet, right? In the case of eyewear, it is 400 or 500 square feet. You just can't use that space. Okay. So I don't think there is any mismatch there at all. Yeah.
Okay, but we are seeing a lot of advertisements for eyewear these days. What's the strategy? Is it going to be a big push in terms of ad spends on the eyewear business? What is the investment in the eyewear business?
Yeah, that's very valid, because if you remember 2 years back, we talked about the same for the watch business. We said we are going to look at our strategy all over again and recraft it. And I think that's what we have done very successfully. If we are looking at 13+% EBIT margin today in the watch business, it's because of those initiatives that we took over the last 2 years, on cost and on the product side and so on and so forth. It's exactly what we are planning to do with the eyewear business now. So we will be spending more on advertising. We will be investing more, I would call it. And hopefully we should get back to that trajectory of both growth and margins there.
You did something very interesting lately. Over the last 1 month, you actually launched your first integrated format store in Hyderabad, where you had jewelry, eyewear, accessories all under one roof. You think that's the model that you would like to follow over the next few months and years? And how many stores would you be looking at?
It's very early to say that. It's not very easy getting real estate of that kind. So I think it's still early days. We will see how this works. And if it does work, yes, why not? We might like to expand this across the country.
Okay. Very quickly, I wanted to ask you what Rakesh Jhunjhunwala asked you on the call. Favor Luba, will you be getting into timepieces in a big way?
I didn't get the call. What is the question? Are we getting into?
Timepieces, into watches, as in not just wristwatches.
Okay, yeah. No. Favre Luba, those were old days. Now it's only wristwatches.
All right.
Favre Luba will be wristwatches. It will be premium, luxury. Okay. And while we did the impairment, I think we still have a lot of faith in that brand.
Okay. And finally, do you think this tailwind of unbranded, or rather, I mean, the entire jewelry space in a bit of a funk after the Nirav Modi episode, this tailwind will last the whole year, you think?
It's quite likely. It's quite likely, yeah.
All right. Okay, Mr. Subramaniam, pleasure speaking with you. Thank you very much for joining us with all these details. Have a great year yourself. So that's a 20 to 25% revenue growth that the company is guiding for jewelry. We'll take a break on. Yeah.
The stock that's surging is Nestle now, by the way. 5% higher for a large cap company. It's really phenomenal. Could well be 10,000 rupee stock soon, the way it's going, but big move on that. It opened with 2.5% higher, but after that it's just surged to 5.5%. And on the way down, just keep an eye on Just Dial. There's been some problem with the stock, out of F&O ban, and today it's been aggressive shorting on that stock.
Just
so
a word
6%
like Nestle, Asian Paints, up almost 5%. That's leading the pack in the Nifty. Didn't perform too well, so now there's headroom to rise.
And you know what, our stock to watch for 2 days now, HPCL, just pull out the intraday chart of that stock. You know, mentioned it was counterintuitive yesterday, but the damage is now in the price, and now once the election is out, if you go by the anecdotal evidence, there's been quite a bit of buying in that one, so now at the high point. We'll take a break, of course. Up next, Ujjivan is a stock on our radar.
Fourth quarter was very strong for Ujjivan. The best show in the last 5 quarters. It was a big beat in net interest income and profit after tax. Samit Ghosh, Managing Director and CEO of Ujjivan Small Finance Bank, joins us now. Good morning, Mr. Ghosh. Thank you very much. How much of the extraordinary performance that you... Yes, sir. How much of the performance would you say was largely because of a low base? Can you give us the underlying rate of growth minus the base effect?
Well, you know, I mean, as you know, last year was a very challenging year for us because we were hit with this whole demonetization, and our first challenge was to really contain the cost of credit, which we wanted to contain around 300 crores plus minus something, and which we did successfully. And secondly, we also were transitioning into a bank, so we had to recalibrate our transition. And what we've shown is consistent sort of growth and performance quarter on quarter. You know, after the first quarter, when we had the big hit from the demonetization, we sort of, progressively improved quarter on quarter. So, I mean, our growth, as far as the business is concerned, is sort of, I think we've grown, 12% in terms of our book. But more it was to ensure that we contain the credit cost and the cost of transition and end the year in black. That was our biggest objective, which we have achieved, and we are very happy.
Okay. Mr. Ghosh, hi, good morning. Can you throw some more color on how the individual lending business has picked up between, housing, SME, where do you see the fastest pickup henceforth?
Well, the largest portion of our business is microfinance, which in terms of disbursement, things like that, it has come back to pre-demonetization levels. So we have sort of stabilized that business, and we will grow that at between 15 to 20% next year. As far as housing and MSC is concerned, they are relatively small. They account totally only 7% of our total portfolio, but they've shown significant growth in last year, and we expect them to grow at least 2x next year, And in addition, we are also planning to launch the personal loan, business and two-wheeler loan business for our microfinance customers. So overall, I think, we want to, I think the your non-MFI business will be at least 15 to 17% of our total business.
Okay. Mr. Ghosh, good morning. 3 days back...
We expect significant growth in...
Okay, please complete, sir.
Go ahead, sir.
No, we expect the housing and MSC business to really take off, but it's in a very small base, compared to our whole microfinance business. But that's where we want to see growth in the next years to come.
Okay, fair enough. The question that I was asking you, Mr. Ghosh, was on this recent report by Kotak and one more brokerage, and there were some concerns about BJP's manifesto in Karnataka and farm loan waiver and concerns about Ujjivan on that. Your thoughts? I'm sure you would have read that report.
Yeah, we've read that report, and I think the concerns, relating to this farm loan waiver and impact on Ujjivan is sort of misplaced, because in Karnataka, largely our portfolio is urban, semi-urban. Okay. We have a very small portion, first of all, in the rural space, And historically, other than Maharashtra, in recent period where farm loan waivers, etc., have had very little impact on microfinance institutions, So we don't expect from our side any significant, impact, even if that farm loan waiver comes around,
Okay. Well, Mr. Ghosh, you have squeezed a lot in terms of controlling costs. Your cost to income has fallen from 76% a year ago to 56.9 in the current quarter gone by. Likewise, your net interest margins have risen from 8.6 to 11.6. I mean, you've done a lot of squeezing. Is there still room there? Or now will you just have to depend on growth? And so, can you give some idea of how much disbursements can grow?
Well, in terms of costs, as I said, the credit cost was totally uncontrollable, but we had aimed at around 300 crores and we ended up at 310. But on the operating costs, we recalibrated, slowed down our branch expansion, etc. So this year, in fact, we will grow from 180 plus branches to over 520 branches next year. So obviously that will have in the next year's operating cost an impact, in terms of it'll slightly increase our operating costs. Yeah.
Okay. How much deposits have you got now?
But as far as technology and
deposits,
well, our total deposit base is about 3,700.
Okay.
3,700 crores, but what we did was, because we were so preoccupied with the other issues, in terms of the demon and the transformation, our focus was not that much on retail, the deposit growing the retail deposit base. We focus much more on the wholesale side, and raising CDs, etc. We were successful to the extent that we were able to replace a large chunk of our high-cost borrowing, which we had inherited from the microfinance institution, and we reduced our cost of funds by 140 basis points. But our retail, frankly, the deposit base was very small last year, and our focus this year will be primarily to grow the retail deposit base.
You have a number in mind? 3,700 crore can become what?
Well, I think next year, 3,700 crores, the total deposit includes wholesale and retail. It will be around, it will be about 8,000 crores, which we are aiming at as total deposit base, of which, the retail will be around 2,000 to 3,000.
Okay, so specifically for the microfinance business, you did mention that you're looking at a 15 to 20% growth. Is that for the full year of FY19?
Full year, yeah.
Okay, and what will this take your overall disbursement growth to? I mean, what are you targeting, say, what could a compounded growth be over the next couple of years in disbursements?
Well, disbursements I cannot recollect, but I think our total book size will be over 10,000 crores, Yeah, it will be about a total 30% growth in our book size.
Okay. We'll leave it at that, Mr. Ghosh. It's a pleasure speaking with you, and pleasure always analysing a great set of numbers. All the very best for the coming year. Well, we have to take a break, but more result reactions are lined up. Mr. Rajkiran Rai, the Managing Director and CEO of Union Bank, joins us